All right, welcome back. The Fed begins its two-day meeting today, and we'll wrap things up with a rate announcement tomorrow when they finally do finish. Now, the CME Fed Watch tool says, get a load of this, there's a 1.8% chance of a rate cut tomorrow. The latest chance gains ground as we go through June and into July. The chance of a rate cut by July stands at around 75%. So you get the feel for what the investment community is thinking. Now, they were happy to see a jobs number that wasn't too good, because too good would have ruled out a rate cut, right? And Wall Street really wants that cut. That would help the stock market go higher, of course, right? Because stocks like cheaper money. Pretty simple. But do we really need the Fed to come to the rescue when it comes to this market again? Does the market really need actually being rescued? Now, the whole problem in the last 20 years, if you ask me, has been too much Fed intervention. They haven't really let the market heal itself. My next guest follows this stuff daily. Please welcome to the show, Mr. Craig Bolanos. Craig, I come from, you used to hear this term all the time, but nobody talks about it on TV anymore, but I'm going to bring it up again. When you see the Fed always coming to the rescue with rate cuts when the market's lower and we don't really actually, everybody used to say we want to get the Fed out of the equation and we want to normalize. We think the Fed's got much too much, a big hand in things, and we want to normalize the market and get the Fed out of it. I want to normalize the market, but we've stopped talking about normalizing the market.
Well, yeah. I mean, Scott, just embrace the new normal. Embrace the Federal Reserve backstop. I wouldn't make a gamble. After all, you said there's only a 1.8% chance that we're looking at a rate cut in May. But I certainly believe that there's going to be at least the gateway or the possibility that the rate cut party starts as soon as the month of June and continues through December. And if we get that, I think everybody can continue to work towards this concept of a soft landing. There's definitely a loss of momentum. That's undeniable. But the soft landing based on the current data is on the table. I do think, though, that we need a little bit of Federal Reserve support to make this all happen.
Well, there's three things, if you ask me, out there. Number one is the rate cuts. Number two is the big, beautiful bill, right? And a tariff deal. So if we get any one of those three, that'll be good. You get 2 out of 3, fantastic. 3 out of 3, I don't want to be short. I've said it already on this show earlier. And I'm not, I just think that those are the 3 things that really could fire this market forward. And I think that we're going to get all 3. Whether we need the rate cuts or not, that's another show. We can do that later. But we'll probably get all 3. And that's got to be good for this market after it's been beaten up. So we haven't had any real good news, really, except for that 90-day pause. And maybe the rare earth deal with Ukraine. That's the only 2 things that have put a smile on the market's face.
Scott, I'm going to jump in on you. I rarely cut you off. There has been some good news.
What?
I mean, I think it's real news. The fact that we backtracked the April 2nd discussion, I mean, that's why the gains have come. In addition, the good news is we've exempted so many of the major things that come into this country. Think chips, think pharma, think electronics. I also think it's real news that the Q1 earnings weren't as bad as feared. So no, I do think we've had legitimate news in the past 3 weeks that has moved the market up to the top end of the trading range.
Okay.
It's real news, Scott, and I'm hoping...
All right, let me hold on though. It is real news, but I'm looking at it from a different point of view. You're right. We had a 14% rally, I think, from the lows in April, right? Something like that. It was crazy. The news was it was way overdone. It was stupid. The way the market took tariffs was absolutely crazy. That's the news. And then when the market realized that, we rallied back. They didn't rally back because America was on track again, and here we go. It's all gummy bears and rainbows. I think it was just they realized that they overdid it.
Well, yeah, let's be clear. I don't want someone to take what I'm saying in a false pretense. Not as bad as feared is not good. Let me say that again. Things being not as bad as feared is not good. That's why I stand behind the fact that we are in this trading range of 51 to 5,500. We're obviously trading above that right now, and it's a great time for people to reassess what do you want your portfolio to look like based on everything that you know now, because investors are getting a second chance to do just that, to rebalance, to fund cash flow reserve accounts, to pick up alternative investments. And I hope the Federal Reserve comes through and just stresses the virtues of flexibility because we don't know what the inflation picture is going to be from the tariffs. We don't yet know what the impact is going to be to economic growth, but let's not lose sight of what you summarized, and you summarized it well. It's kind of like a Meatloaf song from the 70s. 2 out of 3 ain't bad, but if we get 3 out of 3, oh, I feel bad for anyone who's betting against America.
Okay, so I don't know exactly where we're at in this S&P 500 right now, but 56 handle, something like that. I can't remember. But what's your goal? What's your year-end prediction? I mean, is 6,000 in our sights?
We came into the year, our theme was pragmatic optimism. And the investment deployment was to diversify your diversifiers. What does that equate to? If history's our guide and it's the only guide that we have, I think we finish in the 5,600 to 5,750 range, assuming we have $260 of earnings per share on the S&P. So a little bit higher than where we're at right now, but this is likely it. It's kind of a washout year, and then we'll see and relook for growth and economic expansion going forward.
So let's hold on to the gains we got back after April's plunge, maybe a tad higher from there, but you're looking for a sideways year.
And looking for a sideways year. And that's why the search for income and yield and dividends and those things that can buffer and cushion make a lot of sense and should resonate with all investors of various shapes and sizes. But again, if you're investing for the long term, you've talked about this so many times to your viewership, Scott. Take a long-term picture, let history serve you well, and don't get shaken out of stocks, because what about the poor people who sold out some 5,000 points ago on the Dow in April?
I know, it's horrible. I hate to think. Yeah. Real quick, so then how much do you invest in bonds? I mean, do you go out 10 years or do you stay short-term?
I think using a barbell approach still makes a lot of sense. You should load up some stuff on the short side of the curve because the yields are very, very good. And then you need to go out into that 6 to 8 year space. And in particular, for anybody that's looking for tax-free income, there are some steals in the municipal bond market right now in the intermediate term space. And I encourage people to look at just that.
Awesome stuff. Thank you very much, Craig. Always great to have you on. I love your point of view, and you run a lot of money, so you've got the face to the fire for sure. Thanks for coming on, Craig Bolanos. He's a co-founder and wealth manager of VestGen Wealth Partners in Chicago. All right.